Hello everyone. Hope you've all had a good week. Going to be doing another trade review today. Now this is actually on a trade that I didn't record and didn't upload this week. Um, Simply because it was just a sort of warm-up trade for me for the day. And not one I was looking to record, upload, or make any mention of. But I mean, looking back through this week, this seemed to be the nicest trade that I took this week. And yeah, it was actually a really nice trade. So I thought I would do a little review on it. So you can see here it's on the S&P on the 1 minute time frame. This was on Tuesday, the 20th, at 2:45 p.m. British time. So yeah, so let's get into it. So, we can see, so these black lines here is a new day opening gap. Anyone that's familiar with ICT's concepts, you'll know what those are. If you're not familiar, I'm not going to teach you, that's not my concepts. Go learn it from ICT, the man who invented it. So, we can see price has come lower, taken sell side into the new day opening gap. We then get displacement higher out of there, and we start hacking away at multiple levels of buy side liquidity. Now you'll notice each time we take a level of this buy side, we take it, then we get a retracement, usually down into either an order block or a fair value gap. And what's good here is once we get that retracement, we then get another level of displacement higher. And that tells you that it's aiming for the next untouched level of buy side liquidity. Okay, so we have this level here. This is a fairly major, I mean in terms of these runs here, these are fairly minor internal range liquidity pools, but this is the first sort of major one we get. So you can see we run it here with this wick, and then we get the retracement back down into the wick of this bearish order block. Yeah. So we take the buy side here, then we pull on back into consequent encroachment of the wick of this bearish order block, and then the very next candle we get displacement higher, and this candle tells us everything we need to know. This candle closes firstly above the body of this candle, making it an order block, but more importantly it closes well above consequent encroachment of the wick, because when you have a candle like this, especially when it takes buy side and it has quite a long quite a long wick on it, sometimes as an ICT trader you can get faked out a bit. If it closes above the body, you think it's a bullish order block, but actually the final defending PD array is consequent encroachment of the wick. So you get the closure above the body, buy a return to it, but it only goes up as high as consequent encroachment of the wick, and then it starts to come lower. So when you take the buy side, get the retracement, and then you close above that, that makes this order block absolutely 100% a buy. You can have full confidence that this is a buy. Typically, I like to see, when we take buy side, I like to see it come down for sell side, but in some conditions it's not going to do that. In some conditions it's just going to be in too much of a rush, so you're only going to get a slight retracement down into either a fair value gap or a order block, and then it's going to continue. So you do have to be adaptable. You can't always expect it to be as patient as you'd like to see it. So yeah, you just have to be adaptable. So yeah, in this condition we take the buy side, get the retracement, and we show the direction. Like when I say in my videos I like to listen to the market, this is what I'm talking about. When this candle closes, that's it talking to you. It's telling you, look at what we've just done, taken buy side, retraced, and now I'm showing you I still want to go higher. So what does that mean? That means it wants to come for the next level of buy side liquidity. Now if you zoom out a bit, we have relative equal highs here. So you draw a line from these highs. Yeah, you could just target this, but these are close enough that this is sort of the same liquidity pool. And so you're simply just looking for a return back to this bullish order block. So yeah, my first entry was just slightly above that. And then my second entry was when we came down to the fair value gap, again just slightly above that. So I entered 33 contracts total. I don't remember exactly where my stop loss was. I think it was just below this wick. So we're below consequent encroachment of this PD array, but it shouldn't close below mean threshold of this. That's what you want to see from a PD array that you're buying. You want to see it hold, the bodies hold above mean threshold of the body of the order block. So yeah, we buy the open and we buy the fair value gap, and then immediately we get more displacement higher, and then on the candle after that we run the highs. So that was a total of, yeah, we'll say 10 ticks, because with my entry here it would have been just below this. And yeah, very quick trade, a total of 3 minutes, but really just a very textbook setup, and it's me trying to illustrate what I mean when I say listen to what the market is telling you. If we've taken buy side, because the market only moves towards two things really. It is drawn towards liquidity and imbalances, and we don't have any imbalances that are significant enough in here to target. We've got highs, so we've got liquidity. So if it takes buy side liquidity and then tells you that it still wants to come higher, it's already taken this, so that this is no longer its target. If it still wants to go higher, its next target has to be more buy side liquidity. And then so all you need to do, and we've been told by the fact that this only came down to the order block, that it's not looking to kick anyone out yet. It's looking to come down to previous PD arrays and keep going higher. So that's all you need to enter off of. So this was at 2:46 p.m. was my entry, and I just want to go through what dollar was doing at that time. So this was on the Tuesday. Between these two black lines is the Tuesday. Dollar has been very bearish this week. So if we go out to the daily, you can see that we've got this high time frame, daily fair value gap, and volume imbalance at the bottom, and then this line in the middle is the midpoint of that. So let's go straight down to the 5-minute time frame. So 240, let's just do from 230 to 245. So this is the zone we're looking at, these few candles in here. So as you can see, dollar has opened and immediately has just started coming lower. We've taken sell side, offered relief here, shown displacement lower. So it's taken sell side, paired it with buy side. So anyone that sold short here had their stop loss above this swing high. Their trade was entered here, and then they were kicked out of it here, and then it's continued. So we get quite firmly below consequent encroachment of this big daily gap. So we immediately get below that, and then as you can see, look, we're using this as quite stiff resistance. Okay, so we get one move lower here, move higher here with a long wick, and then another move lower. So as I've just said, what I typically like to see is when we take liquidity, I like to see it come up for the opposite liquidity. So if we've taken sell side, I want to see it come for a swing high. If we've taken buy side, I want to see it come down for a swing low. However, again, listening to the market, sometimes it can tell you that it's in too much of a rush and it can't come all the way up here. All the way up to the swing high to kick people out. So because we have a long wick, let's mark consequent encroachment of that. So when I was looking at this, you can see we've got below consequent encroachment at the daily gap, or the daily fair value gap. We've got below that level, we come up, we print a big wick, and we move lower. We then offer relief off the lows, and the bodies hold below consequent encroachment of this wick. So I'm happy for it to come above there, that's no problem. But whilst it's holding this, I'm thinking if we get displacement lower, that's fine. We've already squeezed people out that went short below these lows. Doesn't always have to come all the way up there, it just has to offer some form of relief. Because if you sold short here, imagine when this candle was all the way up here and you sold here, that's not going to be very comfortable. There's going to be a considerable amount of people that have closed their positions there. But the most important thing is we hold. The bodies do not close above consequent encroachment at this level. And then this candle tells you everything you need to know. We hold this wick, and we also retest consequent encroachment of the daily gap, and then we get displacement away from both of those levels. And that you don't need any more information than that. That tells you everything you need to know. If you see displacement away from a high time frame level, that's it. That's all you need. So this was the 240 candle. So this closed at 2:45, 1 minute before my entry, and that's told me the direction of dollar. I'm now bearish on this. Granted, it didn't move lower for a while. You know, it did come up and touch consequent encroachment of the daily gap one more time, but I've got my direction. I know this is coming lower, and so lower dollar means higher indices, higher S&P. And like I've said before in a previous video, the indices don't mirror dollar too much. They don't move exactly how dollar moves. Forex typically does that a bit more. So you don't need to worry too much about the fact that this retraced higher. You typically just need to know generally what direction it's going to move in. And the displacement away from a daily level tells you all of that. So you're looking for lower prices on dollar, and you can continue to look for higher prices on S&P, which has already told you that it wants to do. And there you go. I think this trade closed for about $3,000 profit, which was a perfectly good day, perfectly good trade. Quite a short trade in terms of distance, but profitable nonetheless. So there you go. Hope you enjoyed. Hope you learned something. Have a good weekend. Goodbye.